Hi everyone, in this video we will be covering the revision for BL2 subject where we have selected 4 questions from the revision kit for each of the chapters so that in order to touch base every chapter main areas and prepare ourselves for the examination. So firstly, in chapter 1, we've selected question number 6 as the first question in the revision kit. So let's read question 6. BB Limited expected to make a profit of 12,500 rupees. They ask, what is the percentage change to profit if the sales volume increases by 25% and all prices increase by 3%? So volume, the sales volume here refers to this quantity of sales 500. The prices mentioned is the sales price and the variable cost per unit and the fixed cost total. In this case, fixed cost is also considered as a price here. What they mainly refer to is the cost and the selling price. That's what they mean. So, let's calculate first of all sales. We got volume and price. Then we have variable cost. And that also we have the volume and the price. Then we have the fixed cost. Okay. So sales volume was 500 as we saw and the price was 90 rupees. Sales volume increases by 25%. If we are to directly multiply, we could, since it is an increase, we can multiply directly by 100% plus 25%. So the answer will be 500 into 1.25, 625 units. The price also they say that it is increased and not decreased. Hence, we can multiply by the addition to 100%, which is the addition of 3%, which will give us 92.7 rupees. When it comes to the variable cost, the volume is equal to the sales volume, obviously, because variable costs are the cost per unit and it changes. So if we produce a particular set of units for selling, so the same units will be required for variable cost. The same units will be applicable for variable costs. Okay. So the volume remains 500, same as this we could use. It increases by 25%, so 100 plus 25 will be equal to 625. But when it comes to the cost price, it's 19 rupees, but still it increased by the same 103%. So 19 into 1.03 is 19.57. When it comes to fixed cost, we know that it doesn't change with the number of units. So we take the total fixed cost, which is 23,000 multiplied by 100% plus 3%. Since they refer to the costs, even though they mention prices, I've considered fixed cost because that's what they actually mean. So 23,000 into 1.03 will give us 23,690. Let's take the total variable cost and the total sales. Total sales will be volume into the price and variable cost also will be volume into the variable cost per unit. Okay. So they are asking the change to profit in percentage terms, right? Okay. So first we need to calculate the profit, new profit after the change. So I would say profit after change is actually this: sales minus variable cost minus fixed cost. And let me revert this to profit. Let me reword it here as before the change and after the change. So before the change, we have to still multiply price into volume to get the total of each. And then we should use them to calculate our current profit, which is sales minus variable cost minus fixed cost, 12,500. So they've already given that, and that they've obtained using the before change figures. Okay, now let's take the change. Change in profit. It is the new profit minus the old profit, which is a plus 9,516. That means it's an increase. Also, don't go with a plus or minus sign. Better see it logically. So before any changes, the profit was 12,500, which is lower than the new profit 22,000. So the new profit has basically increased when compared to the old profit. So this is a plus. Okay, then in percentage terms, if we take the formula is, we learned that the change divided by the base or original value into 100 is the percentage formula, percentage change formula. So 9,500 divided by 12,500 in percentage terms is 76%. So your answer will be A. Alright, next let's move to the second question, which is question number 10. A greengrocer sells apples either for 0.35 per kg or in bulk at 7 rupees per 25 kg bag. The percentage saving per kg from buying a 25 kg bag is closest to how much? Okay. So they are basically asking the percentage saving per kg if you are buying a 25 kg bag. So what you need to find is basically you need to compare this unit price with the bulk unit price. So first step would be identifying a bulk unit price per kg. Total price is 7 and 7 rupees is for how many kg? 25 kg. So per kg how much? It will be total price divided by 25 kg. We will get the per kg value, which is 0.28. Okay. Now previously if sold individually, we sell it as at how much? 0.35 per kg. So this all must be in per kg. Then that is only when you can compare. You can't compare two different bases. Fine. So 0.35 is this. So the difference, take the change if it's an increase or a decrease. So but as you see, well, actually they are asking the saving. So by buying in bulk, the unit price is less than if sold individually, which means it's a saving because currently we can buy at 0.28 per kg if we bought in bulk. So the difference, if you take, it's 0.07, that in percentage will be the saving divided by the original price, which is 0.35, which gives us 20% as the answer. Okay. So let's go to the third question. Question 11. A trader's total costs are made up of wages and materials. Next month, wages are expected to be 1000 plus or minus 10%. And materials 2000 plus or minus 20%. Revenue is predicted to be 4000 plus 10 or minus 10%. And the profit next month, they are asking for the minimum profit and the maximum profit. So now what you need to know is first of all, the formula for minimum and maximum values. Especially when it comes to a profit scenario where the increase and decrease of two variables affect the outcome. So the profit will increase only when the revenue increases. So since we need the minimum profit, we select the minimum revenue minus the maximum cost. Okay. And to get the maximum profit, we know that it is revenue what decides mainly if the profit increases or not. So you select maximum revenue minus minimum cost. Okay. So now we will be needing minimum revenue, maximum cost, and maximum revenue and minimum cost. Let's first calculate the revenue portion, minimum and maximum. Then the cost portion, minimum and maximum. Okay. Currently our revenue is 4000 plus or minus 10%. So 4000, the minimum will be the minus portion, which is 4000 multiplied by 100% minus 10%. That is indicated by this particular minus sign. Whereas the maximum amount will be 4000 multiplied by, well, the same way, but the sign differs because it's an increase. So you make it a plus here. Same way for cost. Cost, well, there are two types, wages and materials. So, and they go at different rates. So I'm going to choose wages over here and materials over here. Okay, wages base cost is 1000 and varies by 10%, minimum and maximum. Whereas materials base is 2000 varying by 20%. Okay, let's calculate. So this is 4000 into 90%, 4000 into 110%. 1000 into 90, 1000 into 1.1. 2000 into 80, 2000 into 1.2. Now take your totals. So this is the total. Now let's calculate formula 1 and formula 2. So first minimum profit will be, they've said the minimum revenue minus the maximum cost. So minimum revenue is 3,600 minus the maximum cost, which is 1,100 plus 2,400 of materials, which will give you an answer of 100. Whereas the maximum profit will be the maximum revenue 4,400 minus the minimum costs, which are 900 and 1,600. Which will give you a maximum profit of 1,900. So your profit range will be 100 to 1,900. Let's see if we got that answer. Yes. B. Answer B. Between 100 and 1,900. Okay, let's go to the fourth question of this chapter, which is question number 17. Okay, so they are asking to find the total discount received if a customer receives a 10% trade discount and a 5% discount again after that for prompt payment. The initial pre-discount price is 5,000. So basically they want us to know the total discount received or compute the total discount received. So the pre-discount price they've given is 5,000 rupees. So trade discounts are always applied to the original price. So trade discount of 5%, right? Is it 5%? No, 10%. Trade discount of 10% will be applied to the original price, which will give us 500 rupees. Then the 5% cash discount what they applied after the trade discount must be considered on the net price, which is obtained by minusing the trade discount from the original price. Because trade discounts are not recorded in the books of original entry as you've learned in accounting. Plus, that's because that's the initial discount they give for to encourage trade, but to encourage prompt payment, to make you pay the balance on time, they offer you a cash discount. So the cash discount is 5% applicable on the balance, which is 225. So the total discount values will be 500 plus 225. So the answer 725 must be written here or typed since it's in the computer-based format. So with that we finish the first four questions of the first chapter. Next, let's look at chapter 2, compounding and discounting. In chapter 2, the first question to be discussed is question 4 from your revision kit, which is this. An individual won a competition and was given the choice of a cash payment now of 12,000 rupees. Now 12,000 rupees. Or a payment of 15,000 in 5 years' time. Assume that interest rates are currently 5%. Identify which price the individual should choose. Now, here, the individual will definitely choose the price that gives the highest value, isn't it? Because obviously anybody will earn an income which will actually accept an income which would be of a higher value. So we should find out between these two choices which one is the highest value. But we can't simply compare 12,000 rupees today with 15,000 rupees in 5 years' time. We must value 15,000 rupees for today's value and then compare both choices in today's value, in today's terms at the rate of 5%. So 5% will be your discount factor or discount rate. Okay, so the first question, the decision is choose the highest between the two choices. First choice is cash now of 12,000, and next choice is between today's value of 15,000, payment in 50 how many years? 5 years time. Okay, so for this, let's start calculating. We know 15,000 is the future value because we know it's the future value is obtained by compounding, and then the present value is obtained by discounting, which is what we need to find, which we can name it as X or maybe present value, it doesn't matter. So now we should know what's our present value formula. Present value formula is the annual cash flow or the cash flow actually multiplied by the discount factor. Discount factor equation is 1 over 1 plus R to the power n, right? Okay. Sometimes they'll give the discount factor in your exam. Let's refer to the discount factor table. So we require, let me show you in both methods. So first of all, let's go with the formula method. Present value equals 15,000 is our future value multiplied by the discount factor, which is 1 divided by 1 plus R is equal to the amount that they've given, 5% interest. To the power, how many years? We expect this for 5 years. So 5. If you calculate, your answer will be, your discount factor will be 15,000 basically multiplied by the discount factor of 0.783, which will give you an answer of 11,752. Okay, so here the answer will be 11,752. Now, which one gives the higher value? It is clearly the cash received now, which is 12,000. Okay, before I proceed, let me show you the other method of where you could read the table and obtain discount factor. So probably if you are given the table in the exam, then refer to the table that has this particular formula 1 plus R to the power minus N, and refer to the percentage interest you are looking for, which is 5%, and the year, which is 5 years. So 5% and 5 years meets at the discount factor of 0.784, nearly this. 0.783 is over here, a decimal rounding. Fine, so straight away without doing this formula calculation, you could straight away apply 0.784 into the equation and get your present value. Okay. Hence now, since we choose cash now, the answer will be 12,000 now, which is A. Alright, next we have question 32. A building society adds interest to investors' accounts monthly even though interest rates are expressed in annual terms. The current rate of interest is 3% per annum. Okay. But they are paying interest monthly. So an investor deposits 2000 on the 1st of July. How much interest will have been earned by 31st December? So they are asking the interest amount or interest income. So the first step for interest income, well, first thing we need to understand the period they are asking for. The period is, they've mentioned July to December. Where July they start investing. That's why it starts from July. Start of investment of 2000 rupees. And they've asked at the end of December, so that's why we considered up to December. Then calculate the interest. Now we should then understand whether this is a simple or compound interest. In this case, they've said that interest is added monthly even though expressed in annual terms. So if they say the interest is annual but they are adding it monthly, then they refer to compound interest rates. That means monthly wise your interest get calculated on the total balance of each month. Right? So accordingly, compound interest formula we have learned, which is, you must have learned, it is the total amount multiplied by 1 plus the interest rate of, now it is the monthly interest rate because it's going monthly, right? So you have to divide 3% by 12 months to get the monthly interest rate. And that you add it to 1, that means you increase. And first of all, we calculate the final value once including interest. And then we take off the initial investment and get the balance. So final value including interest, this is for 6 months to the power 6 months. Remember, since here you are giving the monthly rate, you should represent N in months. Don't represent this rate in years and 6 months, it will be incorrect. Always make sure the period you are reflecting in the rate and the N is the same, such as years or months. Okay. Accordingly, so now compound interest, to find the compound interest, what we could do is basically first of all find the future value of the, or the compounded value, I would say, to make it more familiar, compounded value. So the total compounded value at the end of 6 months, is, if you calculate, 2030. Okay. Then initial value of the investment is 2000 rupees as they mentioned in the question. What's the gap? The gap is called the compounded interest for how many periods? 6 months. Okay, because we calculated the future value for 6 months. Hence the answer will be 30. Next, let's go to the third question, 37. Okay. A fund of 180,000 will be required in 15 years' time. 5,000 will be invested at 8% per annum at the end of each year for 14 years. Use the tables to complete the following. The present value of the final fund, which is 180,000 in 15 years' time, that is the final fund. So that fund's present value they are asking. So apply the present value formula, which is future value multiplied by the discount factor. Okay. So future value is 180,000. Our discount factor should be, in this case, at 8% for how many years? 15 years. Okay. So total at 8%. They mentioned the fund will be collected at the end of the 15th year. So we mention it as, for 15 years, the discount factor at 8% is, if you calculate, find it from the table, it's 0.315. So I multiply it by 0.315, or you can either use the formula for discount factor. What's the answer then? 180,000 by 315 is 56,700. Okay, so first one's answer will be 56,700. So they are asking to the nearest rupee. Here it's already, so the rupee, nearest rupee means the one before the decimal place, because we learned that if a number is simply mentioned, it means there's an invisible decimal here, and after that there's a zero. But we don't usually show that way, so we leave it as it is. But if there's a decimal, we will clearly know that this is the rupee value. So always in a whole number, the last digit will be the rupee value, and the one before that is the 10th digit, the one before that is the 100th digit, and so forth. So they've asked to the nearest rupee. It's still a rounded figure, so we can simply put 56,700. Next, they're asking the present value of the annuity. Now, we know what is an annuity. Well, annuity is the fixed amount of money paid for a fixed number of periods. Okay, both must be fixed and determinable. That's an annuity. So in this case, our annuity is 5,000 rupees per year. That also is very important, the period. And how many years they paid for? 14 years. So the number of years they make the payment is 14 years. So now the present value of annuity will be the same formula, present value into annual cash flow, however, multiplied by the annuity factor, not the discount factor, but at 10% and at 14 years. So the annuity factor table is the table represented by a different formula, which is this. Okay, cumulative present value table with this type of a formula. So 8% at the end of 14 years basically is 8.244. So the annual cash flow we pay should be the annual, that means the yearly cash flow, 5,000 multiplied by the annuity factor, 8.244. So your answer will be 41,220. Okay, so that's the answer. So they've asked it to the nearest rupee. Nearest rupee is already rounded. It's at 0. So we put the same answer into the cage. Then finally they asked the payment required at time 15. Now this is not the present value but the future value of the payments we make. Basically the gap between the final fund available to withdraw and the annual payments that we make. So, if you first of all get the gap present value of the payment, it will be the present value of the final fund, okay, minus the present value of the annuity payments, the monthly payment that you made. So your final fund balance present value we found 56,700. Annuity balance was 41,220, which gives 15,480 as our total payments present value. But this is the present value. They ask for the future value because they want the payment in time 15. So apply the future value formula, which is present value multiplied by 1 plus r to the power n. Okay. Into 1 plus 8% to the power of how many years? 15 years. So our answer is 49,105. They asked it for the nearest rupee again. This is the answer we got it in decimals 0.17. Nearest rupee means first of all, so this is the place value of the rupee. The value before that is less than 5. So do nothing to the place value of rupee and therefore it will be 49,105. Next, let's move to question 44. Here they say Fred invested 6 annual payments of 100 million into an investment fund, earning compound interest of 4% per year. If the first payment was at time 0, what is the value of the fund at time 5? We know present value, we know something called annuity and those formulas whatsoever, annuity or discount factor, they all represent the compound interest rate. Remember that. So no matter what they say in the question, like if they don't mention compound, it's still compound if they are asking for present values. Okay. Now let's use the formula for future value of annuity because they are asking for the future value. Future value of annuity formula equals annuity into r to the power n minus 1, and this r to the power n minus 1 actually gets divided by r minus 1. This is a formula you must remember. Okay. Now substitute the value straight away. So the annuity value is 100 multiplied by 1.04. Actually it's not 100, it's 100 million. To the power 6 payments we make minus 1 divide that by 1.04 minus 1. So final answer will be therefore 663 million. This is in million because this 100 is in million. So your answer here must be A. Okay. So the learning here is that you should, we so far learned present value of annuities, but in future value of annuity, this formula must be applied. So it's better to memorize this formula so that you could apply it straight away. Okay, with that we finish the chapter 2 revision. Next let's move to chapter 3, dealing with annuities and perpetuity.